Good morning. This is Vince Lanci. It's the Gold Fix. It's 8:01. We're trying to coordinate a couple things here because we have new people on Zoom from Twitter that are joining in, and we want to be able to take questions from them if possible. And at the same time, uh, uh, we want to give our subscribers preferential, for lack of a better word, treatment so we can get to their questions as well. So we're coordinating 4 different technology formats to one. Okay, today we're going to be talking about. I'll just fill some space here while we're setting this up. Today, if you haven't tuned in before, you'll notice I'm on a phone. Uh, uh, that's just the way it is. That's just my preference for doing this setup. Okay, good. So I have the Trader site, so I can see questions there. Good. Okay, there's a post accompanying this, and you're looking right now at the Trader screen. Don't worry, we're not going to be selling anything today. You will be pressured later on. But what I want to get to is the story. We publish a story almost every day to accompany visuals to follow along. All right. So today's story accompanying the broadcast is the Gold Fix, buy signal triggered, sort of. We bought anyway. The title, basically, what I'm inferring here is, in yesterday's broadcast, we described a momentum signal that was going to hit on Friday, well, potentially hit on Friday, and the fact that we wanted to get in early, but the system tells us not to. We're going to describe what we did yesterday, which was we got long. We got long ahead of the signal, which is undisciplined. But there's a disciplined way to be undisciplined, and there is a cure for this problem for people trading in systems that are in all likelihood going to give them a signal or a reason to buy or sell, but certainly the the signal hasn't been triggered yet. The reason that people get into a trade early when they have a signal that's going to say, if they're on a system or an algorithm that says you're going to have a buy at the end of the day. Well, you have to use probabilities, and this is, being rooted in options. This is very easy for me. So if the market is above X at the close of the day, and if it's above X, I'm going to be a buyer. That's great, but at midday it is already above X, and the problem is, if this is a momentum system, as mine is, and the momentum continues higher, you'll be buying above X, but you could be buying above X by $10, $20. And one of the things about momentum systems with signals, as well as regression to the mean systems with signals, is the market can run away. And so you'll still have a signal, but your risk reward will be terrible. So in a market like gold, which, moving $10 a day is big, you get $5 above your signal and you're still not permitted to buy because it's not the end of the day. Well, then that poses a problem for you because instead of buying $1 above the signal at the end of the day and risking, to simplify it, 1 to make 10, you're buying $5 above the signal, risking 5 to make 5, to simplify it. But that's the idea. So the solution to that in the short term is probabilistic buying, or buying in pieces. So I actually used to do it this way. If I knew I was getting a signal at the end of the day above, and we'll use the S&P, for example. If the S&P is trading 2,600, and I know that above 2,590 at the end of the day, I'm going to be a buyer. And if I'm going to be a buyer of, and I'll pick a round number, 10 contracts, all right, and it's noon and the market closes in 5 hours, and we're above that, I start to say, well, I've got 10 contracts in 5 hours. I buy 2 contracts an hour. So I basically am giving myself exposure on a time basis. Now, that's actually a very good thing to do if you want to preserve your risk reward. And you could also get stopped at as well, because that's what signals are about. It's the end of the day that matters. But there are other solutions to that. But what I did yesterday is I did the buy early, buy later thing. And we'll go through that presently. I also want to talk about the proper solution. And the proper solution when you're trading is something called constant weighted volume bars. I think they're called CWB or CVB, constant volume bars. And we'll talk about how those help. And if you see those on your own charting system or trading system, I encourage you to learn to start using them. I use them for very short term stuff, but for the longer term stuff, I'll average in because I don't want to muddy the purity of the system. So, all right, let's go through the gold fix. First, an important announcement Bloomberg, no more dinners with female colleagues, avoid one on one meetings. It's a Wall Street rule for the Me Too era. Avoid women at all costs. That's not a joke. That was actually written up. We've heard stories about urban tales about husbands driving nannies home and then getting having charges filed against them. I have tried this with my coworkers, and I said, "Look, I can't be alone with women, so why don't you bring a friend?" And that doesn't work either. Apparently, that's also jail time. So don't do that. The charts are sized for mobile. They're not sized for a regular screen. That's how our blog defaults. I'll have to change that default. But I'm going to go with sideways with my phone. Unless you're following on your own computer and you can see things bigger, I'm going to turn the phone sideways so we can see things a little bit bigger and stretch out. Okay, so here's the markets from our overnight report. That's a nice little snapshot of what I would call indices and major commodities. Mike is very nice to put gold up there as one of the major commodities. But we all know it's a yellow inert brick that does nothing. But reality is, please don't tune out if you're a gold bug. We love gold. All right, here's the stock markets across the board. The S&P is called higher, but much of the world is lower. There's a lot of macro to talk about here. There are possibilities that are on the table. I have one trade in mind that I've been putting out on Twitter. But we're going to talk about gold and the trade first, because this is not about gold per se. It's about how to be disciplined. And if you're going to be undisciplined, how to be undisciplined. This is a snapshot of our trade blotter. As you can see, I use sprints. That's not a recommendation. Believe me, it's not. Yesterday, we bought Feb Gold at 12.45.1. It's a multi-week trade. We're normally day traders. We're almost always in and out in 4 hours or at most 16 hours. But this is a weekly trade, and I'll show you why I did it in a second. I mentioned it yesterday. My soft stop was 12.35 and cut off at the bottom there. The stop now is 12.22.80 for the rest of the day, meaning I wanted to let it breathe. And here's a bit of the explanation, but we're going to go into, you can read that. But let's start with the technicals before we get into the trade itself. This is from Michael Moore, and this is only part of his report. But if you want to just boil it down, he's writing from the lower call, get long above 1242. So that doesn't necessarily mean just get long above 1242. It almost always means get long above it and reverse below it. Anything that is support is resistance and vice versa. So what I like to do is I like to look at his report quickly, and I like to say 1242.20 dash 30 1243. He's an oil guy, so he writes in different decimals. 1243.10 is the upside. The downside, you go to downside, is 1236.70. So for me, his range, his initial range is 1242.20, 1236.70, based on the lower call. Now we'll get to where the actual market is in a second. You can read the rest of that. If you see the word decently a lot, it's not because he doesn't own a thesaurus. He likes to keep his writing dry, and he likes to say decently, leaving that up to you. Decently could be a big break. Decently could be a small break on high volume. You have to think for yourself on these things. He's a very good technician, and this is a $5,000 a month product, and I'm permitted to show the gold part of it, not the oil, but I show some of the gold. Okay, so we'll start with, I put the charts up in various orders. We'll start with the monthly just to get it out of the way. The monthly chart, we're not going to get into any VBS thing, but I want you to look at the dark yellow line. The dark yellow line is the 12-month moving average. This works in other products as well, but I believe this is the most important moving average, not the 200-day, although it's very close. This is, I guess, the 250-day moving average. This is a moving average that hedge funds use to trade on the macro. They may buy when it gets way away from it on the downside, like a guy like Goodluck would do, and then maybe sell at the yellow line. A lot of funds will buy above the yellow line and sell below. I've refined it for my own purposes. I would not be a buy. Like, for example, if we cross through that yellow line today, I would not be a buyer. I would be a buyer if the yellow line was crossed through and had been sloping upward. This is also a monthly thing. So it says you shouldn't buy or get long until above it. It does give a positive return on average of 3.5% in gold per month if you're long above the line on a monthly basis. And if you're short below the line, the return is a negative 1 point. The return is a positive 1.7, I think. So a lot of people just use this for buy and hold type situations. All right. The weekly, we're using spot today. Okay. This is not Feb futures. Michael talks about Feb futures. If you want Feb futures, add about 550 to the numbers I'm giving you. All right. This is a weekly chart, and the criteria for a weekly breakout have been met. So gold is on our radar for breakout higher or lower. But right now we're penetrating on the higher side. And those criteria, two of those criteria, which I've shared, are basically this. If 5 bar, we're going to call it 5 week vol on this one. If 5 week vol gets to be 50% or less than 20 week vol at a time frame before, I'm not going to tell you how many frames before, but before, and you'll see it happen before November, where it gets less than half of it. That's a signal that volatility, historical volatility, is beginning to tighten. And then you'll see Bollinger Bands tighten. Now, I use 1.5 as opposed to the standard 2.0 in gold. I use 1.5 because gold is not as volatile. It does give a lot of false breakouts when you use a tighter Bollinger Band, but the Bollinger Bands aren't the system. The Bollinger Bands are the final part of it. I use implied volatility and its relationship to historical volatility, but you don't see that here. So right now, the market says the system says you do nothing until the week closes above the upper Bollinger Band level. The problem with that is it could be a lot higher and you lose your risk reward. And you would also be, this also gives you a two-way system, meaning if it closes the week below, in this interest, in this point here, 1190 and change, you can see the numbers 1234, 21, and 1190 for the Bollinger Band numbers I have. The midline doesn't matter for me. It does sometimes, but I try to avoid it, except for directional indication. You would be long on a weekly settlement above 1234 or short below 1190. And you would expect an increase in volatility. And you will get an increase in volatility. Your first pick is the direction of the trend. Your second pick is to reverse and go the other way. So you get two bites at the apple. The problem I have is I think this is a big, now, for reasons that are not systematic, I believe that we are going to have a break up. Now, before I say why they're going to have a breakup, let's say why I'm wrong. I'm wrong because gold has been very strong with a dollar that hasn't really backed off that much. Gold has been very strong for the week, not for the month, not for the year. Let's put this in perspective. And I think that I have a good read for people like Trump and Xi in this China thing. And I've been harping on the following: that there will be This is going into the G20. There will be progress. There will be a framework, and markets will love it. And I should have just bought stocks and gone home. But even before that, I'm not normally self-promoting, but I also think false modesty is the worst form of conceit. But before that, it was a clear. If you're a poker player, it's clear that if you go back, Mnuchin was the good cop and Trump was the bad cop. Trump was a bad cop, so he promoted Kudlow to be bad cop, and Kudlow wasn't such a good bad cop. So Mnuchin's out of the picture. Kudlow is now good or bad cop or spokesperson, and Pence became the bad cop. What do they call him? Iron Mike Pence when he went over there, and he's probably a good bad cop because of his own convictions and beliefs, in a black and white world, et cetera, et cetera. He's probably the perfect messenger for a person like Trump's temperament. So, knowing how the players were revolving around and how China just didn't change anything, and they were just waiting on it for many reasons we've discussed. Going into the meeting, I figured China was feeling economic pressure because they are having a serious slowdown. If you remember, before this whole trade thing started, China was in the process of deleveraging their corporations. and then they started to slow down, and then the trade thing happened, and now they are in a serious slowdown, and they really can't afford to deleverage, and they're changing capital constraints, lowering margins. They're doing, in my opinion, the Chinese aren't very original as opposed to the Japanese. They're very original in their ideas, but the Chinese are very good at replicating, and I'm not just talking about DVDs and jeans. I'm talking about they learn from what they see, and so they're easing capital constraints now. They're going to encourage releveraging, and you know, as a country, their people can take more pain than our country can, and their president can deal with it as well because he's not reelected. The reason I'm harping so much on China is gold is increasingly being pegged to the yuan, and I don't have that chart here today, but I usually have that. So if the DX is down a little bit and gold is up a lot, and you scratch your head and say why, ask yourself what's in the DX, and I know it's at least 40. I believe it's 60% euro, and Mike has schooled me on that. Gold is increasingly tied to the yuan. So back to the trade. Gold is up, and I think all these things are going to happen. I think a trade deal is going to happen, whether it be real or fake. I don't care, but I think the market is going to move on it, and that means stocks higher, bonds higher, and gold higher. Why bonds higher? Because the Chinese will be buying bonds because they anticipate more trade with the U.S. In fact, they're buying U.S. oil again as of March 1st. That's the news coming out today. They're snapping up LNG tankers offshore at a cheap rate right now. They're going to be buying U.S. stuff again, and maybe they'll, cause Donald a little bit of a problem at election time again. But by no means are they capitulating. This is a country with a 1,000-year plan. We have a 2-year election cycle. So what I want to show you here is why I front ran my own signal, which hasn't triggered yet. And that's because of this chart. Same chart further back. Gold had this phenomenal signal, which we caught. And I've bragged about it enough that I caught it, but I only caught like $15 of an $80 move. But going back to, we got a signal to sell gold, and we sold it for ourselves and for a client. But look at how nicely that just performed. And I'm wondering if we won't get a reversal of that. And that sell off, there were reasons for it other than, my system is only giving you an indication of what people are doing. Venezuela was selling, other emerging markets had to sell to raise cash for dollars to pay debt. These are all things, if you understand macroeconomics, you understand that drainage of the dollar, which is half of QT, causes people with dollar-based debt at emerging markets to make a choice. Either they sell things to buy dollars, they sell their pianos to buy dollars, they sell their gold to buy dollars to pay their debts off to Goldman Sachs and the U.S. government, or they abandon the dollar and they go with the Eastern trade bloc. And that is what QT is doing. It's forcing people to make a choice. But what I'm getting at here now is gold, I think, went under where it should be relative to other fiats, all fiats. It dropped against everything. I think there's a possibility it's going to recorrect. And I know that the yuan is a big factor in this. So I front ran. So I bought one. Okay, let's say I have 5 to buy. I bought one. Today, this is theoretical. I'm not necessarily going to do this. Today, if we're above my level, and I'll tell you what my level is in a second, I'll buy another one. And I'll keep buying until Friday. Now, this is a position that would be held for at least 1 to 4 weeks, 2 to 5, depending on how you look at it. But it is not a position that's actively traded. When I actively trade, I wouldn't put a position onto this. I would just start swing trading dailies and hourlies on a bias. The level that you would be looking at if we closed right here, it would be great. The level you'd be looking at is about 1239, about 1240 on base February contract. If today were Friday and the market closed here, which is 1237 and change, at 5, we'll just add 550 to it. So 1243, you would be a buyer with a stop at 1240 or a stop lower than that in a different way. You can be a stop at 1240 on a settlement, on a daily settlement, on a weekly settlement, or on a print. But I'm going to be long with a settlement, a weekly settlement below 1240, or a print settlement some point below that. The idea here is to risk one to make two. That's what the system is about. The asymmetry in the system, the edge of the system is not technical. It is not in, uh, I'm pretty sure it's going to land on heads. Every trade is 50-50. But the edge is when you make two. When you lose one. And you do it quickly because it captures the impulsive move of usually a bigger move, which I roll my eyes at because I always miss. Um, the yellow line you can ignore there. That's the 12 weekly moving average. Let's go to the 60-minute in gold. The 60-minute, and I watched this last night. The 60-minute after midnight, you see a narrowing, and we did get a 50% signal there, and we got a sell signal. And if you sold it, you would have sold it at approximately, I want to say at approximately 12:30. I don't know, 12:30. I'll put up a live chart in a second. And you would have made some money, but probably never reached your profit target and then been stopped out. And now the 60-minute really shows me nothing today, right now. Daily, however, although it shows me nothing in terms of continued momentum, it does show that we could be at an exhaustion level for a pullback. I won't get into the reasons why. So a 3-day, bear flag, a bull flag could form. Who knows? But there's no apparent help on the daily. It's all monthly right here. Okay, we'll go to live charts so you can see more exactly, so I can point stuff out. But this is a great macro overview done by Mark Chandler. I sometimes default to his stuff because it's very FX based. The overview, the opportunistic trader overview, is an excellent piece. And in fact, the top charts I have here are borrowed from it, not the Bloomberg thing. That's mine. But he's very FX oriented. And although he never talks about gold, he's one of those guys who doesn't talk about gold at all. He implicitly talks about gold, risk on, risk off. China has acknowledged a 90-day period that absent its initial summary, but it's not clear when the period begins. That's fine. You can listen and read the tape on these people. Australia talks about Australia. People trading the Aussie dollar should pay attention to that. He has technical levels in there as well. Talks about Europe and the US. Why don't we talk about, say, 25? I have to go, but why don't we take a look at a couple live charts so we can see where the markets are now? All right, so the dollar is a little bit lower. Gold futures are down, but not much. Silver is down a little bit more. No surprise there. Palladium defies everything, keeps going up. There's rumors of a short squeeze, people taking delivery. I want to make this clear to people. Understand, I've taken delivery of metal before, and you don't literally have to bring it to your house. Palladium is a sponge-like metal. It's not really stored in bricks. If you were to take palladium delivery from a COMEX warehouse, you'd be taking delivery of a spongy material. It is not easy to deliver. So to literally take delivery of a metal is not easy. People, quote, take delivery by throwing a sheet over it and saying it's theirs. If you want to take delivery of 40 million ounces of silver, for example, you can't. You can only take delivery of 10 million ounces a day because of the weight and because you physically have to take it out of the warehouse. So I'm not saying to sell palladium. I'm not saying to fade the rally. But when you read stories like people are taking delivery of palladium, don't necessarily believe that they're putting it in their hands. They're throwing a sheet over it. It's a very spongy material. It's not something that transfers very easily. Palladium, it's kind of like the old Chinese thing. This palladium's for trading. It's not for using. Platinum is lower. Copper, the yuan, the offshore yuan, I think is very important to watch. As goes the yuan, so goes gold these days. That's a monthly chart. We've pretty much covered everything that I wanted to cover today. The takeaway, if anything, is that if you have a discipline and you have a system that says get in on X time, and you don't have uh, uh, the patience because you think you're going to miss your risk reward, then you average in. The other aspect, and I hear Mike rustling, the other aspect is this: learn what constant volume bars are. We'll discuss those another time. I didn't get to
I
it.
was actually going to say, Vince, two things. One, if anybody has any questions for Vince, ask them now. We're actually running a little late for the AM report, so if anybody has any questions, we can get into that. One interesting thing, we had Adam Collins from Movement Capital on yesterday, talking about market seasonality and the latest COT report. And he was pointing out on seasonality that palladium is actually typically December is a very good month seasonality wise. He was also showing euro typically trades well, but you're talking about the metals, and I just wanted to point that out.
Palladium it has become an interesting market, other than the fact that it just keeps going higher. It seems to have, in some ways, sometimes it behaves like copper, and sometimes it leads silver, and it's become its own product. And I don't think we should forget the fact that palladium is, by and large, dominated by the Russian mining aspect of it. So here, let's look at it on the daily. I've seen people, some smart people are telling me palladium is an indicator of other markets,
So
and it worked
Vince,
in the micro.
I
But
was just going to say, just continuing on the conversation here, specifically on gold. We're trading here at Feb at 1243 and a half. We've had a decent rally. I'd actually argue gold has been trading relatively well, whereas the dollar, the euro is only about a big figure off its low for the year. Gold is about $80 off its low and really held the $1,200 level pretty well. Do you take that as a sign that we could really rally in December and January possibly?
well,
Or do you think that this is the level?
well,
Looking
that's a
not
good.
looking at the very short term. I'm looking
No, that's
more,
a good
let's say, a
question
few months
because
out.
it brings in at least three different reasons for the rally, and I'll go through them, but in no particular order. They are end of year allocation coming out. They are seasonality, which sort of ties in end of year allocation, and they are a repricing. All right, so starting with the repricing, the sell off in gold, which was warranted, although not fundamentally it doesn't make sense. Well, it's not about fundamentals in gold. It's about emotions and order flow. That massive sell-off we had in May was, gold had been appreciating against every paper fiat currency for years, which was a slow deterioration of confidence in paper currency. But this sell-off was a repricing against many currencies, and there were real reasons for the sell-off as people were liquidating because of QT. When you look at that bottom and you look at how we're coming off of that bottom, the pressure could be off. This could be QT coming to an end. I don't believe so. But more, what I think is happening is the gold market is aligning itself less with the DX, the euro-based DX, and more with the yuan. And I've written about that in the past about how China is accumulating gold not to go to a gold standard, but as a bridge to having its own petro yuan. I call it the golden yuan. And basically, if Russia's selling oil to China and they want to do it in yuan because they don't want to do it in dollars, again, the QT world is kind of forcing us that way. Russia will say, sure, but we want to kind of have a call on something other than your currency. And this is just a fact. It's happened that China is doing, if not backed, if not yuan backed, yuan with gold backing deals or gold deals with Russia. They're doing yuan with gold deals. But there is gold seasonality as well. That's the second thing. The seasonality of gold is not so much in that it grows like a crop, but it's in hedging. If you look at the expiration months first and you understand those, there's one month that is the most important, and that's December. And oil people understand this because they look at DEES. December month is where most of your hedging occurs. And if you look, there are several ways to look at a seasonality chart. Tracy put up a good one for us. The seasonality is evolving, but I will say this: in the last couple of years, as gold allocations come out, people start buying before the end of the year in anticipation of recommendations by banks putting uh, gold on their list of things to buy. So it's kind of like front running client order flow or prop traders anticipating it. That's one reason gold has seasonality to be long above then. The second reason is the hedging is done in December. So the February contract has less pressure on it. The third reason, a third part of the seasonality is, and it changes from time to time, but historically, gold makes its low in April and its high in October, and that's I don't know why that is, but you can find a chart that'll say that I'm wrong and show the opposite. But the reality of it is that people start buying gold for the December contract, and a lot of times December contract will get a lot of institutional buying, and then make a high and then wash out at expiration. The other aspect of gold that's seasonal, cyclical, actually, I should say, not just seasonal, and ties to your point about, are we, to answer your question directly, are we poised for a much bigger move higher, or is this a dead cat bounce on a weekly chart? I have a strong opinion, but it doesn't influence my trading. I think that QT will continue, and although gold is rallying now, I don't think it's something to get very excited about until it gets above that 12-month moving average on a long-term
Tracy actually
basis.
just put up a nice chart of 5, 10, and 15-year seasonality. And I don't have the exact stats in front of me, but just looking at the chart, December and January, actually January looks very strong for gold.
Yeah, I alluded to that. The chart basically, the January buying is got two reasons for it. One is the December contract, the December hedging is done, and the second is fresh allocations from investment banks come out. We recommend you put 10% of your money in Apple. We recommend this. We recommend that, and we recommend 5% in gold. And what happens is the banks buy in anticipation of their clients buying, and that's not necessarily front running. They just want to have inventory to fill their banks. Prop traders will buy, and what ends up happening is then the retail clients start to buy, and you see the market rally between January and February, and we could be seeing that now, especially now that gold is something that people allocate to. Fast fact: over the years, when oil makes highs near the end of the year and gold makes lows, it's frequently a reason to buy gold because banks will recommend to their clients take your profits in oil and put them in gold as an inflation hedge. I would love to say on a seasonal basis, gold is a buy. Period. That's it. If you're only looking at seasons, and you buy until the market makes newer highs when the RSI doesn't complement it. And that's because the last retail person has bought their last contract of gold, and the funds start to get out. Um, on a more macro basis, beyond the seasonality that we're running into now, that's bullish. I think that you have to look at QT as not ending until either we have a true slowdown in the U.S. economy, or we have a stock market drop as low as 2000. Now, why is this relevant to gold? Because what happened 2 days ago when gold rallied and the dollar dropped and bonds rallied and stocks rallied, I think that's a microcosm of what's going to happen. Again, this is an opinion subject to change, but I think you're going to see right now. I think the Chinese are buying bonds. Let's say that. I think the Chinese are buying bonds because I think a deal is going to be done. It may be reneged on 2 months from now, but a deal is going to be done, or a framework of a deal is going to be done. That's why bonds are stronger. And I think the last couple of days you've seen bonds and algos trading opposite ways. If bonds are up, let's short stocks, and that worked out very well yesterday. But if a deal gets done, you're going to see bonds, you're going to see stocks, and you're going to see gold all go higher on a weaker dollar. And that's a microcosm of our future. If the S&P hits 2000, then QT stops or slows or whatever you want to call it. And what happens is you'll end up seeing stocks scream higher on an inflationary hedge, and the dollar go lower, and you'll actually see gold go higher for a change. But right now, if you're trading seasonally and you see this signal that I have here, and we do end the week above 1240 in February, then you should feel comfortable trading from a bullish perspective for the next month or two as a swing trader, as long as we remain above 1240. I hope that's of help. But again, this is about gold, but it's about everything. Have a discipline and stick with it. But since we are on, does that answer?
Yeah, no, that was good.
Your time?
And it just kind of rolling a bit into the AM report here. What's interesting is I'm just seeing some tweets from President Trump. It's like he saw the stock market reaction yesterday, and he's like, "Hey, we
Yeah.
just had a great G20 meeting. Why is the market down?"
Well,
Uh,
he's Powell. He's going to. That's rhetorical. The next answer is it's Powell's fault.
Well, no, but not only that, he's basically saying that he just tweeted out a little while ago. He goes, very strong signals being sent by China when they returned home, bilateral talks, hopeful for a very historic meeting, all subjects discussed, basically saying, there's optimism on both sides. Why is the market down, sort of thing. And yes, coming up next will be it's Powell's fault in raising rates. We're going to roll into the AM report. Larry's going to be joining us shortly. He was actually traveling yesterday. He is back, but he's just catching up. He'll be back. Now a holiday session where the markets aren't going to be open today. U.S. equity futures are going to trade for about 50 more minutes. Right now, S&P is up 16, bouncing off of yesterday's huge sell-off, plus 3% in the S&P. Russell was down over 4%. Right now we're bouncing about 0.75% in the U.S. indices. It was interesting to note the Asian markets were down, but not nearly down as much as the U.S. Indices. It was really the G20 meeting, brushing that off, and we had the huge gap on Sunday night following the much anticipated G20 meetings. We filled that gap, and then there was some heavy selling once we broke through that 28.55 level, let's call it. And so here we are now. We're at 27.20 in the S&P, which is roughly, I'd say, where we were trading on Thursday of last week. Remember, last week we had a huge equity rally. The euro is trading right now 113.50. The pound.
Wait, the point I think we need to make here, just humorous but true, is we were down 3%. It was the end of the world, which was basically giving up where we were from a week ago. So
sure. We're at like Thursday afternoon levels.
Yeah.
Actually, to tell you the truth, so remember the minutes came out, or I'm sorry, on Wednesday, Fed Chair Powell spoke, and the market rallied from 26.80 up to 27.30. On the fact that he was maybe slightly more dovish and wasn't going to be hiking 50 times next year. Which we really only had about 2 hikes priced in, and right now we're at 1 hike priced in. We are expecting the hike in a few weeks in mid-December, and then from there it's more of a wait and see. And we've talked about this in the past. The wait and see really comes from the fact that nobody knows, whether you're the Fed looking at dots, this and that, nobody knows what's really happening with U.S.-China trade relations, and that's a huge thing for the global economy. And so for a federal, for the Fed to say, hey, we're going to raise rates 4 times, or we're going to cut rates 2 times, it takes more information. We have to see how the whole tariff plays out, because I was just going to say, even though what we've already seen, tariffs have been placed on China, but they haven't really been felt yet. We don't even know the full ramifications. They were supposed to go from 10% to 25%. That's going to be held off. But there are still tariffs that have been in place that we're only going to start to see the ramifications of that in the coming weeks and months. And so that's a big X factor in itself. And so, the Fed has to kind of wait and react, and that's what they're going to be doing, and that's what they said. But the equity markets initially had a nice rally. Last week we were trading down at the 20s, in the low 2600 levels. We were trading 2630, 40 level. We rallied, and then we rallied further on Wednesday on the dovish Fed. Then we rallied on optimism of a G20 meetings going well. Then over the weekend we gapped higher because they went pretty well based on everything that we saw. But the volatility where it is, VIX right now is it's trading above 20 at 2075. We're seeing some volatility where we saw yesterday 3% sell-off in equities. The yield curve, we've been talking about that for a long time. Bonds had a huge move yesterday. The 30-year yield is at 317. We were trading 345 just a few weeks ago. The 10-year got up to above 325 a few times, and now we're at 291. The 2-year is only got above about 290, and here we are at 280. So it's really been flattening. So we'll keep a close eye on that. Yesterday financials were under pressure due to yields, and the interesting thing was the housing market. Home builders and anything associated with housing really got beat up yesterday, and a lot of that, early in the year, housing was getting beaten up as kind of a leading indicator of what was going to happen with the market. But they were saying one of the main reasons that housing was getting beaten up was because of higher U.S. interest rates. As I just pointed out, the 30-year, the 10-year, so somebody getting a 30-year mortgage or a longer-term mortgage, we've dropped 25 to 40 basis points over the past few weeks, and home builders are still getting beaten up. So it's not necessarily that. Maybe it is more about the economy. Or fear of the economy, or foreign buyers, not as many foreign buyers coming in because of the strength of the U.S. dollar.
And banks are not lending like they used to. So the criteria are higher to get money out of a bank. Mortgages are getting harder to get. That's another thing too.
Yeah. But like we said, it's a holiday today, so there really won't be any trading. Tomorrow we're going to have the DOE reports, the energy reports come out tomorrow. We're going to have some economic data tomorrow. But today's really a day to kind of do your homework, look at some charts, take a look at what's been happening, where we are technically, and that's what we'll be doing on the site as well, just kind of posting some charts and giving some thoughts, things like that. Because there will not be any equity trading, but it should be active on Thursday and Friday. Vince, I know you already went over gold, but what are your thoughts on any other markets that you're seeing any sort of opportunity?
A plug of content. We have we're now putting up an oil report in the morning that's for fundamentalists and traders looking for events that happened last night. Today's report is called China to resume oil imports. And I think it's important going into today to read a paragraph of this. I'll just read it out loud. Reuters has an exclusive report that China's UNIPEC is planning to resume purchasing U.S. crude by March after the deal at G20. So there is something material going on. Two major pipelines in Canada are down for oil. Oil prices do continue to fall despite this. I think it's related to financial markets. Bad weather has taken out Libya's crude export terminals, floating LNG cargoes, and this is a sign that a deal could be more real than not real. Floating LNG cargoes are being scooped up by buyers in China. They're at fire sale prices. Not just China, Japan and South Korea as well. Saudi Arabia continues to push Russia to join an oil production cut. But if you remember, if you don't know this, the U.S. will never join a production cut because our industry is fragmented and it's anti-monopolistic. So keep that in mind. That if there is more of a deal, then seasonality of oil aside, or using oil as a risk-on asset, oil's got some upside in it. I think when more of a framework of a deal is announced, whether that be real or not real. In terms of markets, I don't know. Things are open today, just not as
I
a lot
actually
of.
just pulled up a chart of the crude oil, and I'm wondering if Tracy's listening still, if she could chime in regarding technicals. It looks like we've kind of put in a bit of an island. We had a gap higher a few days ago in Jan crude, and here we are. It looks like, we were trading about 51 level. We had a gap above 52. The past 3 days now, we've traded with the low around this 52 level. I'm just wondering what her technical setup looks like. Purely on crude oil here, does it look like we have to retest that kind of gap and fill that gap on the lower side to move higher, or if it's the sort of thing that's really bullish that we haven't retested that for 3 days and it's the sort of thing where we can explode higher?
I correct myself while she's answering that. I said oil was lower in financials. It was 8 hours ago, but now it's reversed, and I think that's because we're seeing the beginning of the effects of the Chinese.
Well, right now, it's actually crude's really flat right now. I didn't actually have the API data. Did you happen to get that API data from yesterday? That did come out normal time. I didn't have that. But tomorrow is the DOE figures, and so at 11 o'clock we'll have the DOE figures, and then we're going to Bryn Kelly talking about natural gas, crude, and then we're also going to have Andy LeBeau speaking about the DOE figures tomorrow. So we'll have a lot of energy.
The APIs were a surprise build, and I think that the market sold off. But I'm looking at the market now, and oil is. You say oil's flat. You're looking at a different settlement time than I am. I see oil is up, and for the last 8 hours, it's been rallying. So for me, it's just a different settlement time. I think this is the beginning of the market starting to factor in Chinese demand coming back in, which brings me to, and I'm going to mention this and then just turn this over to you so you can talk about Tracy's chart that she just popped up there, talking about a bull flag breakout. Watch soybeans too, by the way. All right. So anyway, back to oil. She's got a nice chart up there with the bull flag.
Yeah, that is one. Breakout. Yeah, she's talking about a bull flag breakout, possible retest of the flag, and up around 51.50. Soybeans, the big trade barometer, really. What are your thoughts there?
I don't have any specific thoughts except that I've lost money every time I've traded them because I wasn't familiar with the seasonality, old crop and new crop. But I do watch them as a. I know about soybeans in a macro way, and I know that we're not selling soybeans because China's buying from Argentina. The question is, how much will soybeans rally if there's a rumor of more of a deal? I mean, if China is buying oil as Reuters is reporting, uh, uh, starting on March 1st, and if there is a I'm sorry, if there is a framework of a deal, as I believe there is, and if it will be reneged on right before the election because China can do that, I think soybeans are probably a rally, but I don't. But seasonality is such a heavy effect on that product. I'm not really sure. So the soybean demand in the U.S. will probably go up again if there's a deal, and that's a simplistic platitude statement to make. I'm focused, unfortunately, because of my ignorance of soy and grains. I'm focused on oil right now because there's real demand coming back on, and LNG is being scooped up, and uh, I think as goes everything, so goes oil. Chinese demand in oil goes up, then soybeans are going to go up, then gold will go up for reasons that may or may not be legitimate, and stocks will go up and the dollar will go down. But if nothing happens, and if all some stupid statement comes out of the administration that makes China say, WTF, then we're risk off. But I like the market going into the end of the year in general. I like all markets going into the end of the year, including bonds. But that's not a day trading thing. We should be looking, I think, at things that people want to trade. So this isn't. She has an hourly. Is that an hourly chart or a daily chart up?
That's a daily chart.
That's a daily chart.
And that's what we're talking about there, that kind of flag that's kind of created and kind of that gap from, I guess, like last Wednesday or
Right.
Thursday.
And I'm looking at a 4-hour chart that shows that a bear flag has just completed, and we're assuming a rally. So we can see what goes on there. Wait, she has another chart there. I missed that second chart.
Well, it still has actually in that second scenario initial move higher and then move back down, and the chart would follow seasonality. Tracy's saying December seasonally rallies, then sell off in January. Both are the daily charts. It's interesting, and we've spoken about this, Vince. So you actually just stated you're pretty bullish here, most asset classes into the end of the year. Is that right?
Yeah, but I'm not putting skin in the game on them. It's just an opinion. I am long gold, but I feel that there will be another hard rally and everything because more good news will come out, and I feel that based on watching the poker players, not watching the markets or technicals or even my own system. I just feel that uh, um, uh, China, which is notoriously quiet when Trump opens his mouth, actually complained yesterday. And for me, again, I could be reading the poker player wrong. China is usually quiet when they're letting someone hang themselves. China actually dissented from what Trump or Trump's administration said yesterday, which to me actually is a sign of weakness on their part. For them to say something means that there is a deal in place or some sort of a framework of a deal, of an idea of a deal. And for them to complain means that they've already committed to something. So I think things are happening, and I'm not putting my money where my mouth is on everything, but I'm long gold, and I would consider buying something else if I saw something that I felt I had a good grasp on. But I think we closed the year. Put it this way: I am biased, right? I'm biased because I want Larry to be right. I want the market to close up 3% with the VIX up 20 or 30%, so we can have a nice big down move next year that we can trade into, which
Yeah,
would also.
you pointed that out yesterday. A great chart of that, and especially with yesterday's move that only exacerbated it because VIX was up about 10% yesterday.
No, but
Uh,
we're down, and that kind of bums me out. Uh, but
well,
that's
S&P's still up a few percent for the year right here.
no. Wasn't it up only 2.5% before? Well, I need it up more. No, I think. Look, one thing
You're
I think
saying this in jest, and it's funny. Asset managers are saying that exact comment. Right? I need it up more.
I need it up more. Right, right, and they'll get it up more, and they'll get their bonuses, and then they'll be fired, and then you'll see the revolving door of hedge funds as people look for jobs in different places coming. But the bonuses usually held off until February, so they might not get their bonuses. Yeah, exactly. Everyone needs it up. It needs to be up so people can save face for the end of the year. And Trump needs it up. And on Wednesday election in 2020, it'll be up. And then sometime in October, China will say we're changing the terms of the deal, but that's just all in my fantasy.
Hang on. I think we might have Larry here. Larry, you there?
Yeah, can you guys hear me?
We got you.
We
We're
can't.
just talking about, yesterday Vince showed a great chart of how it's not often that the VIX is up on a year-over-year basis. The VIX is higher right now for the year, and the S&P is higher. And Vince is saying that's kind of like the death spiral of it's a ominous sort of barometer if that happens for the next year.
That's the plate that confirms Larry's intuition that he wants a higher market by the end of the year. And I think,
listen, the truth is, at the end of the day, that doesn't really matter. But at the end of the day, that doesn't really matter. But it would just bode better into the semantics of, the rig. Keep it up for 10 years. But yesterday was, I don't know if you guys went over yesterday's action. I mean, it's unbelievable.
We did, but give us your thoughts. We did go over it in detail, but we'd be interested to hear what you thought from looking at the sectors.
I was caught in a couple of meetings yesterday, but a friend of mine told me there was a huge sell program, from systematic, basically CTA in equity land of, we've heard this before, and Mike knows this.
We actually tweeted that out.
35 billion,
Yeah,
so.
we tweeted that out yesterday. I think it might be called Axiom. I'm not sure, but there's an HFT alert guy out there as well as Nana that points out on a timely basis. Yeah, I think what's happening now is the algos that are operating the most aggressively are the ones that generally will sell the S&P when bond yields are down and buy the S&P when bond yields up. It's kind of like they're doing the whole inversion thing. I'm sorry, I got it backwards. When bonds are up, they'll sell stocks. When bonds are down, they'll buy stocks. And that is that's the QT main algo that's out there right now. The QE algo is buy stocks when bonds are up and buy stocks when bonds are down. So we'll see what happens if there is actually a Chinese deal.
I don't even think they're close to a deal. I said it Monday. People got bailed out because a lot of people went home long thinking that there was a deal and it was bullish. And the truth is, Trump pulled his regular rhetoric of the fact that, it was the biggest. First of all, he literally said it's the biggest deal ever done. And the truth is, I mean, unless I'm missing something, I don't think they made a deal on anything. I think they just suspended the 25% tariffs for 90 days. What was the deal? Does anyone know?
No, there was no deal done other than that. Exactly. They suspended for 90 days, which the clock started December 1st. And everybody's basically saying that, they're not going to be able to accomplish what they want to accomplish in 90 days. And if anything, that's a China victory because they're basically just pushing it off and, that sort of thing.
Well, that's what we said. The clock is running on Trump's presidency. But my question is, he literally said on Saturday or Sunday that it was the biggest deal ever done. Or one of the biggest deals ever done, but there was no deal.
There's no deal done. The terminal, and that's why, right?
That's what sets the algo off,
right.
And everyone was, buying. And the problem is for traders out there, you got to withstand movement that is impossible to withstand. Like yesterday, I think the S&P cash was down 91 points. The day before it was up 35, 40 points. Yet on the year, from yesterday's close to unchanged was less than 30 points. And we're moving 50, 70 a day, which is amazing for trading and amazing, for what we do. But overall, you got to, take your position sizes down and widen your stops because the market really moves,
Guys, I got to jump. I'm going to leave you two to finish it up because I've got to get to take care of some stuff over here.
All right. Thanks, Vince.
Vince, it's a day off. Relax. Enjoy. No market. No cash market today.
So, Larry, based on yesterday's move and basically we're reviewing, last week was a huge rally in the markets. We started to move higher after 2 weeks ago was a very big down move. Last week, we started to move higher Monday, Tuesday. Then Wednesday, we're trading about 26.80. Then Powell came out with what was perceived as a more dovish stance. We rallied from about 26.80 to 27.30. Then we rallied a bit more onto Thursday, Friday, expecting some sort of positive news at a G20. We then gapped higher, which took us up to 28.14. Overnight, we traded down to 26.98. Where do you think we stand here, and what do you think the trade is for the next few weeks into year end?
I don't think you can take anything honestly from yesterday and put it into the next day. I think it's all program trading, manipulated markets that are just moving in one direction exorbitantly to basically blow other algorithms out. My position is still the same. I came on Monday. I said that whatever that print was the high of the rest of the year.
Yeah, you
I
did say that one.
I I easily stand by that. I mean, obviously, we're not close to that. I do think there's a potential that we could close the fact is 17 days in the year. We're nowhere on the year. So, it's just a flip of a coin guess of what we're gonna be. I see the futures are up pretty good this morning after looking like they were gonna get smashed. The DAX is higher than where it was trading yesterday late by about 100 points. So these markets have stabilized. These markets have stabilized a bit, and we'll see. We'll see in general where they end up. But my opinion is they should end lower. They're going to probably rig them to end around here or higher, and next year is going to be some of the highest volatility that we've ever seen, and there's going to be a lot of uncertainty, and there's going to be there's a lot of catalysts. You have the China catalyst, you have Mueller will hopefully before his presidency ends,
Sometime before 2030, he should have some information.
Right, exactly. So, the slow play on that will probably be pretty much out. That'll be a catalyst, and weaker economy, weaker earnings might be the mantra for next year. But again, you got to be flexible. But yesterday's action was interesting, all predicated, I think, off of a big program trade that there's no real buyer in the market. You know, it's just computers, and you know if you look at a week ago Monday, okay, so what is that, 7 days ago? S- you know I would say six trading, there's no trading today, so it was like 5 6 trading days ago. The S&P was at 2630, looking like it was going to implode down 1.5% for the year, and you came in Monday. By Wednesday, we were up on the year, and by Friday they exploded them. So, you know, and then in one day they took 100 handles out. So, you got a market that's moving very fluid, and I think there's good trading out there to be had. So
Absolutely.
and
Today it's a holiday. It's the president's funeral, so the markets in the equity and bond markets, or the futures in the equity markets, are going to stop trading in about 30 minutes. We are still going to have later at 12 o'clock Dave Floyd of Aspen Trading. He'll be speaking with us, showing us technical analysis. The way he looks at markets, it doesn't need to be open. He can really just teach a class on the different technical analysis that he looks at. So that'll be going on at 12 o'clock, and we'll have replays because I know many of you won't be there. But that's going to be the schedule for the most part of the day. We'll be updating on different news that we're seeing and different thoughts that we might be having. But obviously, without the U.S. equity market open, there isn't as much going on. Tomorrow, we're going to have a very busy schedule. We're going to have Tony Greer, Bryn Kelly, Andy LeBeau, Tom McEntee, and we're going to have the DOE reports. We'll have the natural gas reports. We're going to have the crude oil and natural gas reports, I should say, and some U.S. economic data. So it'll be, I'm expecting, especially after yesterday's price action, Thursday, Friday should be pretty busy. And I think the next 2 weeks, really up into the Fed, it should be pretty busy. And then, probably after the Fed, after we get to the 20th, things should probably quiet down into the end of the year with not as many trading days. But we're only up about 1.5%, 2% in the S&P year to date. And, we have only not that many trading days left, probably about 15 trading days left, and probably about 10 good trading days left.
Yeah, the Dow is up 1.25% on off of closes on a basis. Obviously, after today, if we end up staying there, it'll be more. And the Nasdaq is up 3.68. But really, the point is, hedge funds all over are getting killed. asset managers not making money, regular RIA types that are like in our building not making money. They're down anywhere from 3 to 7, because you got to realize 90% of people have international exposure at some point, whether it's small or large, and in everybody's portfolio is international stocks. So those markets are down anywhere from 10 to 25. So you add that into kind of a flat US, and you're looking at down returns. So they're down anywhere from 3 to 10%. So it's going to be a interesting year. Whether or not the Dow closes up or the S&P closes up isn't really going to help the returns. The returns are pretty much in, and they're not that good. So next year should be interesting.
Absolutely. Any closing thoughts on Larry, or is that pretty much it?
No, that's it. Just relaxing, watching markets from my house, and I wish everybody a good day.
All right. Thanks. We'll talk to everybody in a little bit.